For the better part of the last decade, people had been told buy the dips, and buy the dips was an incredible strategy. And buy the dips usually has a companion, and that's sell the rips, which is basically when you see sharp rallies, they could be used as selling opportunities. That comes back to basic trading. You want to buy low, sell high, so that's more or less a weird, fancy rhyming way of saying buy low, sell high. But there's more to it than that. When you had the steady advance that we saw more or less from 2008 through much of 2018, there really wasn't a great opportunity to sell. It wasn't really until earlier this year that we started to see what looked like a topping pattern in the market. Realistically, if you just had dry cash, you would want to just keep buying it and keep investing it. Now we're seeing more of a two-sided market. There's a real reason for that. The Fed is not behind you in the way it was. I'm sorry if I'm repeating myself, but it's a lesson that really has to be taken into consideration. We saw remarkable monetary stimulus of a type and a form that we'd never seen before. And when you put a lot of money into the system, it creates inflation. That's classic economics. But yet you can argue, wait, we didn't see much inflation in terms of most commodities type of items. That's correct. Where we did see inflation was in financial assets. And that inflation essentially was going to the stock market. And you can really say that the increase in valuations, the increase in PE that you saw, was the inflation being expressed into financial assets, at least certainly in the equity market. Now we've started to see the Fed begin to tighten. It actually happened starting over a year ago was the beginning phase of the tightening. But what we're seeing now is that the Fed is actively taking money out of the system. To a certain extent, we didn't really see the effects of it till later this year, as opposed to earlier this year when they were really doing it in earnest because of the fiscal stimulus that came from the tax legislation. Now that's behind us. The Fed continues to be on a raising path, and you're starting to see a lot of the market rallies get squashed in fairly quick fashion. We're taping this as of Tuesday afternoon, when we saw a big rally Monday on the hope that there was some sort of truce in the trade war with China. And we've now, as I'm sitting here, we've more than given that back. Why would that be the case? First of all, there was a lot of hope in the stuff that came out of the G20, but realistically, there wasn't much substance. What the president said and the official White House communique didn't necessarily agree. The Chinese have been fairly closed-mouthed on the topic, so it's not clear what was actually agreed to. Again, any lessening of the hostilities on the trade front is considered good news by the market, by the markets, by the economy, et cetera. But there wasn't that much there, and so it's not really clear what was agreed to other than maybe a 3-month hiatus. And secondly, we started to see the effect of the monetary tightening. For the first time, a small piece, in a long time, not for the first time ever, but the first time in a long time, we saw a small piece of the yield curve invert. For those of you who are not necessarily familiar with the dynamics of the yield curve, let me take a moment to explain. Normally, yield curves are upward sloping. That is, the shorter the maturity of the fixed income instrument, the lower the yield, all things being equal. So we'll use government bonds, which all have an implicit guarantee from the government. So what you'd expect to see because of liquidity preference and inflation and the fact that inflation tends to increase over time, normally what you would see is an upward slope if you plotted it from left to right. The three shorter term instruments yielding less than longer term instruments. And as of yesterday, the 2- and 3-year notes showed an inversion versus the 5-year note. What that meant was that the 5-year note was yielding less than shorter term instruments, 2 and 3 years. That's typically when you talk about a curve inversion, you're talking about either the short end, either the 3-month and 6-month bills yielding higher than the 2-year or the 2-year yielding higher than the 10-year, or some combination of all the above. So what we saw was a very minor inversion, but that was really not well received. Throw onto it. So you throw on two things to explain what you're seeing today, Tuesday, and that is, number one, the market got a bit ahead of itself in sort of proclaiming the end of the trade war, and number two, the inversion spooked people, and that's why you're seeing the financial stocks and other interest rate sensitive stocks getting hit especially hard. So going back to the why to sell the rips. I'm not going to say we're in a bear market yet. That we're way away from that. Although we have, by certain measures, seen some. You can call it that we've corrected. Bear market rallies are sharp, short, and painful. The reason for that is institutional investors fear being underinvested just as much as that's in many ways one of their biggest fears. That's underperforming your peers or underperforming your benchmark, because realistically, who wants to pay a manager just to put their money in the bank? I can do that without paying a management fee. We all can. So underinvested portfolio managers tend to chase performance. The other thing is traders who short the market, it's an uncomfortable position for people. People don't always like being short the market. It's not natural for the great majority of traders. And so when they start to see rallies kick in, they charge back in. They don't want to be caught short, or they don't want to be, or you have longer term investors not wanting to be caught underinvested. So that leads to opportunities to nimble traders who really are just sort of market neutral, shall we say, to use those as selling opportunities and try to look to use these sharp rallies as selling opportunities and look for opportunities to come back in and keep the trade moving. So long way around, I still believe that if you're going to be buying the dips, you have to now have the mindset of sell the rips.